A single sentence, scribbled on a small piece of paper and taped to his wall, saved a legendary trader from financial ruin and made him a billionaire. Paul Tudor Jones, one of the greatest traders ever, was on the brink of losing it all. He was making a classic, amateur mistake that was costing him a fortune. But then, he found a simple rule that became his shield, a rule that forced him to play defense and would define his entire trading philosophy. This is the story of that one rule, a rule you've probably seen but might not fully grasp. Losers average losers. Understanding what that really means is the difference between blowing up your account and building lasting wealth. Before he was a Wall Street titan, and before founding Tudor Investment Corporation in 1980, Paul Tudor Jones was a young, hungry trader cutting his teeth in the volatile cotton pits. He was brilliant and driven by a powerful offense. His early years were marked by bold, high-risk investing, making huge bets on market trends and using leverage to juice his returns. In those formative years, his fund achieved something many thought was impossible: 5 consecutive years of triple-digit returns. This aggressive style made him millions, but it also held the seeds of his own destruction. The same instinct that fuels a meteoric rise can also trigger a catastrophic fall. He was playing a game of pure offense, a style that works great until it doesn't. Every trader knows that feeling, the rush of a winning streak, the sense of being invincible. But Jones learned, through painful experience, that the market has a brutal way of punishing arrogance. He realized that an offensive strategy alone, without an ironclad defense, is just a ticking time bomb. One wrong move, one trade that gets out of control, is all it takes to wipe out years of hard-won gains. It was a realization that forced him to completely re-engineer his approach, shifting his mindset from making money to protecting it at all costs. October 19, 1987. Black Monday. The Dow Jones Industrial Average crashed an astonishing 22.6% in a single day, a day of pure, unfiltered panic that vaporized fortunes and scarred a generation of investors. For most, it was a catastrophe. For Paul Tudor Jones, it was his masterpiece. While the world burned, his fund didn't just survive, it thrived. He reportedly ended that month with a 62% gain, cementing his legacy by pocketing an estimated $100 million from the crash. How on earth did he do it? It wasn't a lucky guess. It was the result of a profound philosophical shift. Jones had obsessively studied historical market patterns and saw the storm brewing long before it hit. But the real secret wasn't just in predicting the crash, it was in how he had structured his entire operation to withstand, and even profit from, that kind of chaos. He had already installed a new prime directive into his brain, a quote he'd become famous for. The most important rule of trading is to play great defense, not great offense. This wasn't just a catchy phrase, it was a complete system. Before Black Monday, he had already embraced the core idea of preserving capital above all else. He had the rule. Losers average losers, hanging over his desk, a constant, nagging reminder of the single biggest mistake that blows up accounts. The 1987 crash was the ultimate proof of his defensive philosophy. It proved that in the game of markets, survival is the prerequisite for success. You can't win if you're not at the table. And Paul Tudor Jones had built a fortress that ensured he would always be able to trade another day. So, what does this legendary phrase actually mean? Losers average losers. Coined by Jones himself, it's a blunt, no-nonsense warning against the practice of averaging down. Averaging down is when you buy more of something after its price has already dropped. The logic feels so tempting, doesn't it? If you bought a stock at $100 and it falls to $90, buying more at $90 lowers your average price to $95. You tell yourself, now I just need a small bounce to get even. It feels like a smart, strategic move. In reality, it is one of the most destructive habits in trading. Let's walk through why it's so lethal. Imagine you enter a trade with a planned risk, say, 1% of your account. The trade immediately turns against you. Instead of just cutting the loss like you planned, your ego kicks in. You think, wow, It's on sale now. I'll buy more. So you double down. But that original 1% risk? It's not 1% anymore. If the price keeps falling, your loss accelerates exponentially. What started as a small, manageable mistake has just snowballed into an account-threatening disaster. You've just turned one bad decision into two. You're no longer trading your strategy, you're trading on hope. Hope that the market will turn around and prove you right. But as any pro will tell you, the market can stay irrational a lot longer than you can stay solvent. By averaging down, you are not fixing a mistake, you are compounding it. You're throwing good money after bad, and in the process, you're breaking the number one rule: protect your capital. Jones understood that giving in to this temptation even once could be fatal. That's why for him, this wasn't just a guideline, it was the law. If averaging down is so destructive, why is it so common? The answer has nothing to do with charts and everything to do with human psychology. It's a trap baited with our two most powerful flaws, ego and denial. First, the ego. Nobody likes being wrong. When a trade goes against us, our first instinct is often to defend our decision, not to question it. Taking a small loss feels like a personal failure. Doubling down, on the other hand, feels like an act of defiance. It's you telling the market, I am right, you are wrong. This ego-driven response is financial suicide. Paul Tudor Jones fights this with a powerful dose of humility. He famously said, "Every day I assume every position I have is wrong." Think about how profound that is. He starts from a place of skepticism, not conviction. He isn't looking for reasons to be right, he's actively looking for the reason his trade is now wrong. Second, there's denial, which usually shows up as hope. The trader stares at the red on their screen and thinks, it'll come back. They're anchored to their entry price, believing it's the correct value and that any move against it is just noise. This is wishing, not trading. Jones's philosophy is the polar opposite. He says, if I have positions going against me, I get right out. If they are going for me, I keep them. It's that simple. No wishing. No hoping. There is only the reality of the price. This is why Losers Average Losers is so brilliant. It cuts right through all that emotional noise. It's a simple, mechanical rule that forces you to face the reality of a bad position before it spirals out of control. It transforms trading from an emotional battle into a disciplined, defensive game plan. If you've ever felt that pit in your stomach watching a red trade go even redder, if you've ever just prayed for a bounce to get back to even, then you need to hit that subscribe button. Because what we're talking about today is the antidote to that feeling. This is the core of professional risk management, and mastering it will change your trading forever. The rule Losers Average Losers is the foundation, but it's just one part of a bigger defensive system designed for one thing: capital preservation. Here's how to apply it like a pro. First, know your exit before you even think about entering. For every single trade, Jones knows his maximum pain point before he pulls the trigger. He states, I know where my stop risk points are going to be. I do that so I can define my maximum drawdown. This is non-negotiable. It could be a price level that proves your idea wrong, a technical indicator, or even a time limit. If the trade doesn't do what you expect within a certain time, you get out. A stop loss isn't an admission of failure, it's your ticket to survival. Second, demand a huge reward for your risk. Jones is famous for targeting a 5-to-1 reward-to-risk ratio. This means for every single dollar he risks, he's aiming to make 5. This is a total game changer. A 5-to-1 ratio means you can be wrong 80% of the time and still not lose money. It completely flips the psychological burden of trading. You don't need to be right all the time. You just need your winners to be way bigger than your losers, which you keep small by never, ever averaging down. Third, scale into winners, not losers. There is a right way to add to a position, and it's the exact opposite of averaging down. Professionals scale into winning trades. If you enter a position and it immediately moves in your favor, proving you right, then you can consider adding to it. Jones himself would increase his position size when he was trading well and shrink it when he was trading poorly. You add fuel to the fire that's already burning bright, not the one that's sputtering out. Fourth, when in doubt, get out. Jones preaches, if you have a losing position that is making you uncomfortable, the solution is very simple. Get out, because you can always get back in. Your gut is a powerful indicator. If a trade is stressing you out, it's a sign that either your position is too big, or the trade is just plain wrong. Protecting your mental capital is just as important as protecting your financial capital. Sell the position, clear your head, and wait for a better setup where you are in control, not just hoping. The legacy of Paul Tudor Jones isn't built on a few spectacular predictions. It's built on decades of disciplined risk management. His entire career is a masterclass in playing defense. While countless other traders have burned brightly before flaming out, Jones has endured by obsessively focusing not on how much he could make, but on how much he could avoid losing. The rule losers average losers is more than a trading maxim, it's a philosophy of survival. It's the understanding that in a world of total uncertainty, the only thing you can truly control is your loss. By refusing to add to a losing position, you are choosing discipline over ego. You are choosing strategy over hope. You are choosing to be a professional risk manager, not an amateur gambler. So, take a hard look at your own trading. Are you playing offense or defense? Are you trying to prove you're right, or are you focused on protecting what you have? If you have to, tape that sentence to your own wall. Losers average losers. Let it be the shield that protects you from your worst instincts and allows you to stay in the game long enough to win. If this rule finally clicked for you, drop a play defense in the comments below. And for more deep dives into the minds of the world's greatest traders, make sure you like this video and subscribe.